Hey, finance fam, welcome back to my channel. If you really like money, do not turn from this video. We're going to dive into 5 very expensive money mistakes that I see people make that go above and beyond just the basics that you usually hear on the internet. Spend less than you make. Don't have a high car payment. Make sure your mortgage is 30% or less of your gross income. We know. So let's dive into some more advanced strategies here. And by avoiding these mistakes, that'll help you grow your wealth exponentially. The first major expensive money mistake that I see people make is they don't do any tax planning. Especially business owners. They can be some of the worst at tax planning because they're so busy running their business that they're not even thinking about it. They're just making the income, paying the taxes, and dealing. So some general things that I see in terms of lack of tax planning would be things like businesses not choosing to be an S Corp over just a basic sole proprietorship with their LLC. The S Corp election is an election that you usually do when you start to reach a certain amount of profitability, and it helps save you a lot of money on self-employment taxes, aka payroll taxes. So it's definitely one to pay attention to if you're starting to become profitable in your business. Another big no-no and lack of tax planning mistake that I see is people contributing to the wrong types of retirement accounts for their tax situation. The biggest key to proper tax planning is knowing your effective tax rate, aka your average tax rate. And this is actually not very difficult to find at all, but a lot of people do not take the time to learn what the tax rate is that they're even paying on their income. Here's how you're actually going to find your effective tax rate. You're going to go to your latest tax return and pull up your 1040 form. It should be one of the first forms that you see when you pull up your tax return. And what you're going to do is you're going to go down to line 15. This is your taxable income. And then you're going to go down even further to line 24. This is your total taxes paid. Doesn't matter if you've paid estimated taxes or if it came out of your paycheck, whatever. It's accounted for here in your total taxes paid. And what you do is you take line 24, your total taxes paid, and you divide it by line 15, your taxable income, and bada boom, bada bing, you have your effective tax rate, aka your average tax rate. So if you don't know this, it's really hard to do any proper tax planning to begin with. So that's step 1. Go do that after this video. Another lack of tax planning mistake that I see made comes with stock options, restricted stock units, or restricted stock. This is all stock-based compensation that a lot of people get at their employers. And a lot of people make a lot of big mistakes with stock compensation. They either miss taking a 83B election, which allows you to kind of lock in taxes today if you're very confident about your company's shares in the future. That's a really big tax strategy, but you have to elect it very shortly after you receive the shares. The second big mistake that I see with equity-based compensation is the timing of sales. A recent example is I had someone reach out to me in a frenzy because they had some stock-based compensation in the form of ISOs, aka incentive stock options, and they didn't realize that exercising these options could give them a higher tax bill than they expected. These particular options, there was a lot of gain baked into the option upon exercise, and that led them to what's called an AMT adjustment, alternative minimum tax adjustment, that they didn't even know existed. Essentially, exercising the options caused a tax bill that they weren't expecting. So this takes really thoughtful planning. It takes knowing the rules. When it comes to equity-based compensation, it takes knowing your hold times that you need to have for the best tax benefit. And these rules can be very convoluted. So it's very important when you get equity-based compensation in the form of stock options, RSUs, or restricted stock, you want to make sure that you consult with a finance professional to look at your individual situation and make sure that you're making the right moves with that compensation. Okay, enough with tax planning mistakes. Let's move into the second major mistake that I see, and that's not taking a 401k match at work. It's unbelievable how many people do not do this. Yes, it is absolutely 100% free money. You may need to vest to be able to keep that free money. So it's very important to find out from your 401k administrator what the match is. What are the parameters of the match? For example, you may have a 6% of your salary match. Say your salary is $100,000. 6% of that match will be $6,000. And let's say your employer will put in 50% of that 6%. That means of that $6,000, which is 6% of your 100,000 salary, they will give you $3,000 of free money. 3,000 is 50% of 6,000. So you're going to need to know what percentage of your income they're going to match up to, and what percentage of that percentage are they actually going to put in as your quote unquote free money. Let's look into what a match over time can compound to equal. So I pulled up some wage estimates from the US Bureau of Labor Statistics. And, you can see here all occupations. The data that they have for 2022 is showing an average annual wage of around $61,900. So I took that and I broke it down in a financial calculator just to kind of give us an idea of what this match will compound to over the years. So here's the information. Basically $61,900, and then we are taking 6% of that. So I actually ended up diving into the data around 401k matches. And typically you're going to see anywhere from a 2% to a 6% match. So what I did was, for this specific example, to find out what the match compounds to over time in terms of dollars, is I'm using a 5% match. From my experience, this is pretty common, especially with larger corporations. So, let's go with 5%. So let's take that $61,900 and let's multiply it by 5%. That gives us $3,095 for the year to equate to that 5% match cap. So now the question is, what amount of this $3,095 is the company actually going to put into the account? We're going to go with 50%. So basically, you as the employee, you're putting in the 5% of your salary, which is $3,095. And then your employer, in this case, we're going to go with 50% match. They're going to match half of that, which comes down to $15.47.50. So this is the amount of the 5% salary that your employer is going to put into your 401k account. So what I did is I divided that by 12 to basically imitate that. Every month when you get paid, your employer is going to put in essentially $128.95 to match. So I took this and I wanted to find a compound interest calculator that took into account raises, because most compound interest calculators that I've found on the internet, they are just simple compound interest calculators where you put in your rate of return and it's giving you an amount, but it's not taking into account that every single year you're probably going to get a raise at work. And over time, your income is going to increase. So I wanted to find a calculator that actually did that without going through and dealing with an Excel spreadsheet. And I ended up finding one. I put in a 3% deposit increase every single year, assuming your raises, give or take. Usually that's around 2%, maybe 3%. So basically, of course, it depends on inflation, but I took the monthly amount over 30 years, because you have probably a working career of around 30 years at least minimum, and that 3% increase in your deposit, and then compounded that at 7% rate of return monthly. And what that does is it gives us $217,000 at the end of that 30-year period. So that free money that your employer is putting in based on the numbers that I gave you, which are lower numbers. A lot of people make a lot more money. So this is going to be even more impactful the more money you make. But using that, average salary of $61,900 and using that 5% salary cap with a 50% match on that, that's going to give us over $200,000 of free money over that working career. So look, who doesn't want an extra couple $100,000 at the end of their career, right? Most of us would want that. And again, the more you make, the more impactful this becomes. Or even the more your employer contributes for that match. Say instead of a 50% match, they're doing a 100% match of that salary cap. that's even more impactful. So do not let this go by the wayside. If your employer is trying to give you free money, find a way to get the free money, because that can equate to hundreds of thousands of dollars of free money over your lifetime. It's a no-brainer. The third biggest mistake that I see people make is they buy a home in a city that they should be renting. Yes, I know you probably think I'm crazy, but let's look at an example in the city that I live in, Austin, Texas. Austin, Texas is known for high housing prices and high property taxes. And a lot of people do not think about the property taxes until it's too late. And they've got, a 20K property tax bill every single year. And they're sitting there like, whoa. So this was why I wanted to use Austin as an example for this exact purpose, because I had someone recently come to me and they were like, I really want to buy a home. I feel like I'm wasting my money. So I tried to explain to her that in her situation where she was living in Austin, she was actually at an advantage to rent over buy. And I'm going to explain why that's the case and how to make this work in your favor. So this is an example of a downtown high-rise condo where you can buy a condo, right? You can own it. And essentially, when you look at the payment breakdown of this home, okay, you can see that you've got the principal. This is assuming a 30-year loan at 7.3%. Right now, that's what interest rates are running. So this is even more relevant right now with interest rates being so high. Maybe the math changes with rates lower, but for right now and for a long time since I've lived in this city, this has kind of been the situation, where renting in a situation of downtown or a hot area can make more sense. So basically, we've got a condo at $795,000. The payment is, $4,400 in principal, a 18, call it $1,900 a month in property taxes. Take a second to let that sink in. $1,900 a month in property taxes, give or take. That's a lot. that could actually be you could rent an apartment just on the property tax alone payment in some areas, right? Even in Austin, closer to downtown, you could probably find an apartment, not in downtown, but close, for about $2,000 a month. So that alone should kind of tell you the story here, which is very interesting. Then you've got your, this is putting in insurance, and then the HOA fee. You have to remember that to live in a downtown high-rise condo, you're going to have an expensive HOA fee. In this case, it's over $600 a month for that HOA fee. When you're renting a high-rise condo, that all is going to be included in the rent. So you can see that for this almost $800,000 home, you're looking at about a $7,500 mortgage payment, with a very big chunk of that being property taxes and, the HOA, which is not very fun to pay, but hey, you want the amenities and you want the lifestyle, you got to pay up. So this is a 2-bed, 2-bath, about 1,000 square feet. Now, I went on apartments.com in this exact area where this condo is, just to kind of get a feel for what rents are costing for the same kind of idea, mid to high-rise condo right downtown, right near the heart of everything. What is that going to run me in rent? And it's going to run me around $3,800 to $4,000, assuming a 12 to 15 month lease. When you have a shorter lease, that gets way more expensive, but let's assume, a 12 to 15 month lease. And you're looking at around $4,000, give or take, for one of these really nice apartment buildings. That's essentially what you're going to be paying. So when you compare, let's go on the higher end, you could probably get into something for under $4,000. But let's say on the higher end, you are paying $4,000 for that downtown condo / apartment in your high-rise building. Compare that to a $7,500 mortgage payment, and that is a significant difference in payment. That's essentially $3,500 a month that you could take and invest it elsewhere, right? And that can be pretty impactful, especially if you are younger and you have more time. Then take that take the $3,500 and invest it. But if you really, really, really want to own real estate, then I understand. But just because you are renting doesn't necessarily mean you're making a bad decision. This is something that I've done over the decade is rent expensive, rent luxury, rent downtown living. I don't want to buy downtown living. The fourth big expensive financial mistake that I see made is people have too much concentration in their portfolio. What the heck does that mean? That means you own too much of just one or two things, right? You own too much and you do not have a diversified portfolio. We like diversified portfolios because they basically help you balance risk and reward. If you have all of your net worth tied into one company stock or just a few, stocks, then that is probably going to be quite a risky situation that you're in. If it works out and you have you happen to have all Apple stock in your portfolio and that's your entire net worth, well, boy, has that worked out for you excellently, right? But it doesn't always work out that way. So if you have a situation where a lot of your net worth is tied to one specific thing, it could be Bitcoin, it could be a stock, it could be real estate, it can be across the board, pretty much any asset. If you're all in one thing, that can be financially catastrophic, especially in the stock market world. We've seen the Enrons. If you're a high level executive and you have a lot of stock in your company, there are ways to diversify that stock without actually selling that stock, higher level strategies. Definitely want to talk with a wealth manager about that. So there are solutions for people that are in this situation. But I even see people that are not high level executives that are really in a place where they cannot afford to lose their wealth. And they're doing this. They're putting it all in one thing. So you do not want to lose your wealth in a flash. And simply put, that can happen. We've seen the 2008 financial crisis. We've seen it happen in different stocks, different corporations. We've seen it happen in Bitcoin. It doesn't matter. That's why we like to have a diversified approach. The fifth mistake that I see is not controlling the sale of your assets, AKA have some control over those capital gains, because if you do, you can really save a ton of your wealth from taxation. I recently chatted with a retiree who sold some assets, and he wasn't really thinking about how that was going to control his income and his taxation. And it also ended up increasing his Medicare premiums because he ended up making over a certain amount of money. So it can have a cascading effect if you do not strategize this properly. I would say the best thing to do is to know your effective tax rate, right? Know what brackets you're in and know how to strategize, not going too far into those higher brackets, and space out selling capital assets over time. You can pace it out over multiple years. And when you make over a certain amount of money, in addition to the 20% capital gains rate, you're going to have to pay a 3.8% surcharge tax, which basically gets your capital gains up to 23.8%. So if you can avoid that and try to stay in that 15% bracket, or if you are lucky enough in a year where you can take advantage of 0% capital gains rates for some of your money, that's another strategy, is kind of maneuvering that to be able to take advantage of the 0% bracket. Now, with that said, you don't want the fear of taxation to affect selling an asset if you really need to sell an asset. But if you have control over it, and if you pay close attention to your taxable income and where your capital gains rate is going to lie, then you can put a little bit of extra care onto this to make sure that you're holding assets for a full year to take advantage of long-term capital gains rates instead of selling before that year mark, right? That's one thing you can do. That's very simple. And overall, just do your best to try to control how much taxes you're paying on your capital gains. Mindfulness, awareness, all of it is going to help you build more wealth over your lifetime. Okay, so to recap, the 5 big money mistakes that I see made beyond the basics. 1, lack of tax planning. I showed you in this video how to go find your average tax rate. Go do it now so that you know, because that's the first foundational step to proper tax planning. 2, not taking a 401k match at work. Please just do it. It's free money. And when it compounds over time, it can equate to hundreds of thousands of dollars of net worth. The third big mistake is buying a home in a high cost area when renting actually might make more financial sense. Take the money that you save from renting, yes, save, and invest that money instead. Remember, rent expensive luxury and buy where it makes financial sense. The fourth big mistake I see made is people get too risky, they YOLO, and they have these super highly concentrated investing portfolios. They are not diversified, and that can be a very risky thing, especially if your wealth is mostly concentrated in high beta or high risk assets like equities, Bitcoin, and things like startup investments or venture capital. The fifth biggest money mistake that I see made is not controlling the sale of your assets, aka not controlling how much taxation you're going to have on your capital gains. We want to have as little taxation as possible, so we have a max wealth. That means possibly pacing out sales of capital assets over time, over years, and just being a bit more methodical about it instead of just selling whenever. That also means holding assets 1 year and a day to take advantage of long-term capital gains rates if you can. Again, if it makes sense to sell in that moment, you don't want taxation to be the reason why you don't sell if you need to sell or if it's a great time to sell. But if you have the opportunity to methodically think through this and try to pay as little in taxes as you can, then why not? All right, finance fam, if you found this video helpful, if you learned something new, please share it with all of your friends and family. And also subscribe and like this video because that'll help more people find this content. Comment below in something that you learned from this video or something you maybe weren't thinking about that you are now going to put in practice in your own financial life. And I will see you next time.